Value-added tax, one of the crucial areas for both student and the business people. What does it mean? How it works? What does it mean by input and output tax? What is the way to do the accounting for value-added tax? Be with us till end of the video. This is Milad Akbari from Akbari Education. Welcome to your channel and part 3 of value-added tax. We have a series of 4 parts for value-added tax which explain all the areas required for students and the businesses. It discussed about input and output tax, what is value-added tax, how it works, and different areas of accounting and these things. In this part 3, what we're gonna cover? We're gonna cover the accounting for what? On the sales and on purchases. What is the value-added tax control account, an example and a practice question. Let's go ahead directly. The accounting for sales tax on sales. Sales tax charge on sales to customers is not part of sales revenue of the business. Remember this point. If we gonna purchase a marker to resell it back, in case of the sales, when we sell this product for $10 and there will be $2 of tax, this $2 is not belong to business, and this is the liability of the business that need to repay that to the tax authorities. That's why only $10 will be counted as a sales to the business. But how we gonna record that? At the below of the screen you can see that, but let me write it on board. On such a case, there will be cash payment from the customer side, or there will be recorded as account receivable of the business for future periods that they need to pay you this amount. And suppose we sold this marker for $12, there will be $12 overall, but this $12 is made up of $2 tax, which is the liability of the business, and the net sales of the business of $10. This $10 is belong to the business, and this is the amount related to the business. But however, we need to receive the $12 as a whole amount from the customer. For the purchase side, the sales tax charge on purchase is not part of the purchase cost or expense of the business. This is the same case. If you purchase this marker for $6 and you paid $1 tax, that $1 is not cost for the business. This $1 is the amount you will recover that, whether from the customer or from the government or tax authorities. That's why the $6 will be recorded as expense. Let me record that. Suppose I had a purchase of this marker for $6. This is the net purchase of the business. Value-added tax is somehow receivable, and that's why it's recorded in nature of the current asset as a debit of $1. The total amount, whether I paid as a cash or it is account payable for future period, will be $7 credited. The total amount need to be paid to the supplier, and this is totally responsibility of your supplier to pay that $1 back to the government, to the tax authorities. This is how we're gonna go ahead with recording of that. But remember, this $2 and this $1 will be accounted or will be adjusted or will be recorded in another T account or account which is called what control account or sales tax control account. Let me draw that. Suppose this is my T account and it have a debit and a credit. Value added tax control account is there to record that. In case the amount you have received, the tax you have collected is more than what you have paid in previous year, for current year you will have some liability as a what that need to be paid, and that liability or what is payable to the government, and payable, the opening balance for the payable will be on credit side. Remember, If you don't know these accounts, there is a video in our channel which describe the elements of financial statement. Go and see that and come back to this video. And if you don't know about the nature of debit and credit fully, there is another video as the name of Secrets of Debit and Credit. See that one, full explanation of the debit and credit nature with example there, and come back. By the way, if you have a liability of value added tax and you need to pay that to the government, the value added tax will have a opening balance brought forward, and that brought forward amount is suppose X amount. During the period, suppose you had some sales. You remember account receivable was debit, what was credit, sales was credit. The what amount will be credit for the amount you have received, and now you're liable to pay that back to the government. That's why your what account will be credited due to sales for X amount. Suppose you have a purchase. If you remember, the purchase was debit, the what was debit, and the account payable was credit. That what was debited because of the amount of $1 you have paid to your supplier, and you need to recover that. It is receivable. That's why the what account will be debited due to purchase for X amount. And in a condition that the company have additional liability, extra liability, then what is receivable on what area with the tax authorities, the closing balance will be on debit side because you have more liability. The closing balance will be in this side as the name of carry forward, and this will close the account. That's in case. And in case that you have more receivable than the value of your payable, on such a case you have a current asset, and current asset, the asset nature is to be closed on credit side. For this nature of debit and credit, you can go to the video of Secrets of Debit and Credit and review that there. So it will be closed here. But remember, suppose on a period you have some receivable from the tax authorities and there is no payable. Receivable will always come as a debit, and that kind of situation, the brought forward balance will be as a debit balance. This is the nature of the T account, and whatsoever transactions you have in relation to the sales tax or what will come into the what control account. Let's go with an example and it will clarify this T account. Suppose a sales tax registered business sells goods for $1,200 plus $240 sales tax. The net price of the sales was $1,200. There will be $240 sales tax, and the purchases goods costing $200 plus sales tax of $40. The net price was $200. $40 was the sales tax. Assuming these are the only transactions in the sales tax period, we have only these two, and that input tax is fully recoverable. What he have paid for the purchases is fully recoverable from the government or from the customer. How much sales tax is due or payable to or from the government? Record the transactions in what control account. Or what control account is here already. So you can see there is no brought forward, there is no opening balance here. That's why we will erase that. For the first point, we have some sales of $1,200. What we're gonna record, the account receivable will be debit, value added tax will be credit, and the sales will be credit as well. How much is the sales? $1,200 net amount. How much is the value added tax of the period? It is $240, and the total account receivable will be $1,440. This amount will go to where? Value added tax control account. In credit nature as a liability, the amount you receive from the customer, and you need to pay that to tax authorities. $240 is the amount credited. And another side, we have some purchases of $200. So on such a case, purchases account will be debit for $200. There is tax, value added tax you have paid and it's receivable for $40, or you have account payable of total $240. This what is already the amount you gonna pay or you already paid. That's why it's recoverable, receivable, and it's gonna be recorded here as the $40. Now, in simple language, you have $240 payable and you have $40 receivable. What is the net amount? Net amount is $200. But for closing such T accounts, you will record the area with the highest amount at this below area, $240, and the remaining balance of $200 is extra payable to make the T account balance as the name of carry forward amount. Let's go ahead. There is a practice question. The practice question said a business sold goods that had a net value of $600 to Lucid PLC. This is the customer, and the sales net price was $600. What entries are required to record this transaction if sales tax is payable at the rate of 17.5%? Remember the rate. This is the area. We have already solved a question. So the sales amount is how much? It's clearly mentioned it is $600. What is the rate of tax? 17.5. You simply multiply the 600 multiplied by rate of tax 17.5 will result to $105. This is value added tax, and the total of this amount is receivable from the customer, and this is totally your responsibility now to transfer $105 to the government. The total is equal to $705. $705 is the amount receivable. Which option is the correct one? Of course, B. We have $705 as a receivable. Belong to who? This account is belong to Lucid, and you're gonna receive from Lucid what is credit, and sales is also credit. Thank you so much for being with us till end of this video. I appreciate if you can subscribe to our channel, press the notification button, and share such a crucial video with your friends. Thank you.